The top 8 single stock ETFs for high yield income in 2026. Who could they be? Amazon, AMD, Meta, Broadcom? We don't know, but we're going to find out and we're going to explain to you how we came up with the top 8. Welcome back to the channel. I'm Doug, the Retirement Guy, and today we have one of these really, I think, helpful videos for everybody who are investing in the single stock ETFs. A lot of these are the weeklies. This is what everyone's always talking about, the weekly incomes. So let's dive into these, each and every one of these funds, which ones make them tick, which ones don't do what it does, and really get to the top 8 across the board. Before we get into the video, investment disclaimer. This video is not financial advice. This channel is purely based on my thoughts as I navigate my own personal investment journey. So please always do your own research, and if you ever need any financial advice, always contact a professional and talk to them. If it's tax purposes, if it's investments, always talk to them. There's a lot of risk factors in single stocks. So we always got to make sure that the volatility and the risk are fit your nature. So please do your own research and just follow along for the entertainment. So understanding single stock ETFs. Single stock ETFs offer exposure to individual companies rather than a diversified basket of funds. They provide a higher potential returns and income, but with majorly increased risk. Now, the risk comparison, single stocks versus traditional, you can see every one of them is in a higher category: volatility, risk, return potential, and dividend yield. So in single stocks, you have a higher volatility and you normally have a higher distributions. In traditional ETFs, you normally have a little lower volatility and more stable returns. So same old thing that we've always said, risk versus reward. So the risk versus reward profile is they're trying to find how that leverage can create returns, create weekly distributions, company-specific risk, and higher income potential. So it really comes into is how do we control all this to make it work in our portfolio? Well, it's the distribution rate sweet spot, okay? I always say this is a 30 to 70% is really the sweet spot where you want to fall into. And the question is why? Well, that gives you the optimal income. It provides that significant distributions for the income-focused investor. It also has NAV stability, prevents erosion of the fund's net asset value. Doesn't control NAV erosion. What it says is we're going to be able to control the NAV stability either by dripping, reinvesting, or generating enough income that we can cover the losses that come from the NAV. That gives us NAV stability. And a sustainable pace allows the fund to maintain that stable growth across the different markets and different periods of time. So rate too high or too low. If you go above 70%, you can erode your NAV and sustainability because there's something out there why the number's going so extremely high. And if you go too low, you're not going to provide enough income. You're not going to be able to cover your NAV stability again. So everything works around that net asset value across the board. So I also want to say everyone here is most of the information I got from this is going to come from Seeking Alpha. And Seeking Alpha has actually become a partner of our channel, and they want to offer you a $30 off the premium sign-up package of Seeking Alpha. And with the coupon description below, I'll put it down in the description below. This is, I'm not trying to promote this. They came on to us and said, would you mind? Because we are using them so much that we said we need to have a discount. They gave the $30 off. So if you guys want to be part of Seeking Alpha, here's a great way to save yourself some money on the premium program, which gives you all the information behind the scenes. Our first fund we're going to review is going to be the Amazon AMZW from Round Hill Weekly Pay ETF. Now, Amazon came in with a very strong analysis ratings of 60 strong buys, 10 buys, 3 holds. So the consensus came into a strong buy. Now, the neat thing about Amazon is this: they have a strong EPS and a revenue growth. 60 analysts recommend it to be a strong buy. There was no sell ratings, positive tech indicators, and it's an undervalued potential with that potential upside of 25%. Now, analysis price targets are options and not predictions and may change. But what they're looking at right now is that the current price of Amazon, basically looking at this thing, could have a forecasting between $195 to $340 per share. Okay, if they have that, that's where they're getting into their 25% upside swing. Realistically, the average across the board is about 15 to 22%. Again, these can always change in the fund. So when we're looking at this fund currently, AMZW, the entry price is about $43 on average. The current price is about $44. So it gives us an opportunity to get into the fund to participate into it. Now, when we take a look at the underlying asset compared to the ETF, this is the big thing that we do. Look at the lines. In blue, you have the ETF. In the brown, you're going to have the actual underlying asset. And you can see the gap between the two. Well, that's the leverage being applied. That's the leveraging of Amazon using that ETF. So you can see the thing matches almost to a T of every movement that Amazon makes, that the ETF is following it to a key. Now, using leverage has helped it gain about a 5% year-to-date total return gain over the Amazon underlying stock. This is why I put this as fun to look at, is that it has that opportunity to continue growth. This thing has a 25% growth of Amazon. Well, we can expect the ETF to do equal to, if better than, that 25% because of the way the chart has been doing since the day the fund came out. So these are the researches that we tell everyone you got to do, and the deeper dives you have to do into these funds. Our next fund, NVIDIA, NVII from RecShares ETF. Now, I liked this fund because of the balanced leverage approach with its covered calls. So let's start off with, first step is the NVIDIA price analysis. Current price right now, 187. The targeted price is about 260, or a 39% potential upside. The RecShares, the growth in income, NVV, over the past 7 months has a 29.20% yield with an 11.36% for a total return of 40.56. So here's a fund that is actually growing. It's giving you positive cash flow and giving you a nice total return with only 7 months underneath the belt. So when we take a look at the NVIDIA growth in income fund over the past, we're looking at a 16.95% growth. So we're able to almost match the growth side of it. And remember, RecShares uses that 50-50 blend, which 50% of their portfolio is going towards the leveraged income and 50% is going through growth. So their 50% is actually able to obtain almost equal growth of what NVIDIA has actually done, excluding anything for income. So across the board, the analysts have come back with NVIDIA being 55 strong buy, 9 on a buy, 5 on a hold, and I was shocked when I saw one came back as a strong sell. And I could not understand that, but the experts see things differently than we do. But NVIDIA is so strong with the IT stuff or AI stuff and their chip side of things that I just see that this still is a great play for at least for 2026. So you can see the price difference, about the 39% from where they're currently at to the targeting price. And here's the things I keep coming back with is the heartbeat of the AI. NVIDIA is the central driver of AI with the tech sector. The balanced approach that NVIDIA puts to it, the little bit of leverage that they have to it, it's just strong across the board on every side of it. That's how it got number 2. And I like that the REX shares has done what it's done. But now taking a look again, this is how more research, this is where I'm showing you the more research that needs to be done on your part and my part is this. Look at the 2 lines again, matching up spot for spot across the steps. And the gap between them is the leverage. Okay, so again, if NVIDIA is going to go up, this thing's probably going to have the same exact movement that you're seeing currently. Now, I know this all can change, and I know that this is, dividends will always change. They're not guaranteed. The numbers here are not guaranteed. Things could happen that REX shares change their strategy for some unknown reason. And here's what happens. But right now, with the current strategy that they have and everything in place, everything looks like a positive for NVIDIA, IVII, with NVIDIA as its underlying asset. Number 3, the Robinhood. This comes out of Roundhill again. Now this one here is where it starts getting a little bit touchier. The analyst rating of Robinhood itself. 16 say it's a strong buy, 3 say it's a buy, 5 put it on hold, and 1 strong sell. So it is a little bit more of a mixed bag with Robinhood. Now, I personally own this already and have a couple thousand shares of the HOOW in my portfolios. So this is one I wanted to understand the most about. The targeting price that they're looking at Robinhood, the current price that they had was 121. They're looking at to go to 153 for 26% increase. Now, the crypto market is expected to improve in 2026, and Robinhood has a direct exposure to the market of crypto. And I always thought them just being as another trading platform, but they are actually the major crypto trading platform out there. So when crypto does good, they do good. When crypto does bad, they do bad. So Robinhood is really controlled by that crypto markets. So let's check the underlying stock compared to the ETF. And you can see that Robinhood is well above what Roundhill has done with HOOW. So I started questioning this. Why is the big gap? Everyone else the ETF has always been outdoing the underlying stock. Why is this one done what it's done? And it comes to capping. And I didn't realize this until I did some little deeper research dialing into it. And I said, oh, you're right. Selling covered calls, which generates that big income, caps the upside of the fund. And you can see here that it's capped the upside while the Robinhood had been free for all to do what it wants to do and climb. But the first part is they match each other almost bump by bump again. These things are very, very close to each other in reacting to. If Robinhood goes up, this one's going up. Robinhood goes down, this goes down. So across the board, they're matching each other, but it's capping the upside of the growth. And this has been a heavily, heavily growth fund. So we talk about it before is volatility. What these funds need and want is volatility. And volatility is not going up to, $100 share and then back down to $50 share. That's not volatility. That's market adjustments. What they want is in the single day, they want that fund to go from $50 to $60 to $55 to $50 to $60. They want to bounce in a certain range that they can pick up all of their premiums from their option calling. Versus here, that Robinhood was on a run. And we see that Roundhill was able to keep with it, but with capping on the top side. So number 4 is going to be AMD. This is the Round Hill AMD Weekly Pay ETF, AMDW. This is a semiconductor opportunity. The distribution so far with the Round Hill package is 71.93%. Now remember, the numbers are going to be different because this fund came out July 24th of 2025, so we don't have a full year under the belt. So far, year to date, we have a dividend yield of 37.95% with the goal of hitting that 71.93. Distributions of $18.18, excuse me there. So why does this make it so strong? AMD is another player like NVIDIA. It works in that strong AI and semiconductor growth system. The current price of AMD is $203. The AMD targeted price is $239, which is a 34% upswing. The analyst saying for AMD is 37 strong, 8 strong buys, 8 buys, and 11 holds. So across the board, the underlying financial health of AMD, strong quarterly EPS growth, it's increasing its revenue, it's meeting every analyst's expectations, and again, it's in that AI package. So when we take a look at this fund, is AMD looks healthy and AMD looks like it's going to grow. The question is, how will Round Hill handle this, and can they continue to do what's going on? So we take a look at deeper dive into comparing the two, the underlying asset to the ETF, and you can see 4 in a row we have matched tooth for tooth. Again, what happened here? It's the capping of the upside of the growth of the funds. So you're looking at about a 40% difference between the total returns between the two. And you can see that the end of, and even with this chart, we'll show you at the end of the year that the AI, they called the bubble, was questionable, and people started holding back. But once they realize what AI is going to continue to do and how it's moving, you can see that these things have the potential of continuous growth. So another strong asset under management, which would make an ETF a very strong piece as well. Number 5, GOOW from Round Hill's Google Weekly Pay ETF. So when we take this one into full consideration, going right back to it, and this is where I'm going to show you guys a little bit of questionable sides of things. Google's had a great run. Their current price is $314. Their targeting right now is $336. So that's a 7% upside. Now, in analyst report, 54 are a strong buy, 9 are on a buy, and 12 are on a hold. Now, the one thing a lot of people don't understand about Google is they are not just a search engine, and they are not just a browser. They are in so many different markets. And when they introduced Gemini as the AI, and now that they're taking Gemini and putting it into their search engine, they're an AI player. Gemini is doing very, very well. And Google has a very strong financial performance. They're hitting on all their targets. Okay, so they're doing a lot of instruction into Google itself. So you look at the chart performance since January of 25, they were at a $300 price point. They're moving all the way up, and today they're about that $314 range. So they've given up a little bit, but they're actually looking for a nice 7% growth, which is a steady growth out of the fund. Now the GOOW, $72 million in assets, just a hair under 1 million shares. Again, came out in July of 25, so we don't have all the hardcore numbers to finish it out on their actual tracking. But as you look at them, they're in my sweet spot of the distributions. When we look at the overall comparison of the two, again, the leverage is paying off with Google and Round Hill versus Google itself. 89% total growth in Google with Round Hill, 69 for the underlying asset of Google itself. The leverage is helping push this one up and above. But for 5 straight funds that I found, every one of these are matching the total returns and the patterns to a T. And that's the critical part. That's what makes me feel comfortable. I have the right underlying asset for an ETF. Now, does the ETF strategy work? And we're seeing here with the leverage definitely shows a positive growth. Number 6, the Broadcom, AVGW from Roundhill. Again, another Roundhill. I like their strategies across the board. This one here shows a 33% upside in AVGO or Broadcom's price. Strong buy, 39. Buy is 10 and hold is 3. So the quarterly EPSs are growing. The revenue is staying steady. The fund is doing what it needs to do. When we look into it again, the Roundhill versus the underlying stock had a good, bigger, stronger growth. Capping is in effect. But again, where we're at now, 6 in a row, matching to a T the underlying asset. Number 7, Meta, undervalued opportunity. This one here, when I got done with my research, I said this is where I personally will end up putting more of my money into because of the whole undervalued opportunity. So this one here, 54 saying a strong buy, 11 are a buy, 6 are a hold. Again, one strong sell. But this one had a 27.69% up potential. The current price is $645 a share. The targeted price $825 with a 27.69% upside potential. Looking at the underlying stock, this is where we're going to see the leverage help and hurt. Okay, the cap side is hurting. It's not picking up the cap. You can see the gap between the two lines. But look in November when Meta had a drop off, we had a major drop off as well. So that is the leverage working against us versus for us. And then capping it is not allowing us to capture and get up to the higher growth. Now the Meta METW from Roundhill is actually, they show here, down 9.42% when the Meta is up 7.27%. Exactly what my chart was showing you is that if you don't have enough distribution, if you don't have enough package to control the NAV assets under value, when it has struggles like this, you're going to lose some money. But as they say, Meta is rebuilding and reorganizing, and they're expecting a 39% growth into the fund this upcoming year. That's why I put it as the underachiever. This is the one that probably is going to have our best growth for 2026. And our number 8 is going to be Uber from Roundhill. Now, why Uber ETF? It's not relying on new chips or AI legislation. It's continually making money ability. The global network that they're putting in place, and it's a diversification from AI because so many are into AI. The current price of $84, the targeted price $109, a 29% growth onto the fund. We have 54 strong buy, 6 are on a hold, and 1 is a strong sell. Now the fund, again, came out in October, so it's very new, but it's starting to come up on the radar. When we take a look at this one here, once the fund started coming alive, and you can see where they studied themselves, they studied the asset under management, and they have to, again, get themselves in their footing. That's why I tell you this is a new fund. These numbers will show accordingly. Capping the upside, leverage is hurting it a little bit, but evaluating itself at the current price that it needs to be. It's the same problem I've talked to previous about Roundhill, that they start a fund normally at $50. And most of these funds will get down to about the $20 price range. Well, it's a $30 drop off. And all they're doing is trying to build excitement and build cash. That's why we always say hold 60 6 months before really investing into it. But what I found here was 8 very strong funds that match the underlying asset by movement. So every one of these, when the fund goes up, they go up. When the fund goes down, they go down, and accordingly. So the portfolio summary and the sweet spot analysis, again, Amazon, Nvidia, the Robinhood, the AMD, the Google, everybody fit right inside of our really our sweet spot across the board. 7 out of the 8 are right in the 40 to 70% distribution sweet spot. The diversified, we have tech, we have AI, and we have e-commerce. The balanced approach to both growth and income across the board. Excuse me. Honorable mentions. Everyone's going to come back and say, well, what about this one? What about this one? I give you 5 additional funds that were so close into the marketplaces. And they do so much. You can look at the tech picks. And then we have the crypto and satellite positions. So guys, there's a lot of chances out here for you to do your own research to find out maybe some fit you better than what my top 8 did. But across the board, I came up with 8 solid pieces that really work with. So my investment strategy and earning entry points. Well, again, I'm just giving you information. This is not something that I'm not a financial advisor. I'm not doing it any way, shape, or form. But the entry strategies is trying to get into the funds at a discount. I'm looking to buy in the Amazon from Roundhill that $40 to $45 price range. I've learned what the price matching is, and I'd like to see if we can catch it at that $40 price point. We're jumping in. Nvidia, anything above that below that $29.50 price point. Same thing with Roundhill, or with Robinhood, a $56 one. 49 on AMD and Google under 70. What I also use though is dollar cost averaging. So it's a consistent investment, regular investments into funds. Instead of just dumping one big fund, I just set it up every month. We're going to do this. Very similar to a drip, but with my own money going back in. It reduces the risk potential. And it gives me different points of entry. If we have a fund that starts to drop off, I'm ready to go with it. The portfolio allocation, with the new stuff coming into it, tech and AI is going to probably be about 40% of my weekly ETF funds. Crypto is going to be about 25, stable income about 20, and other options are going to be about 15%. So I'm trying to maintain that 40 to 70 cent per distribution rate so that I can either drip some of it or reinvest it back in to cover any NAV losses and work accordingly. Guys, I know it's a lot of information. I know it's a lot of research. It's a lot of done. Maybe not put in the best package that I've ever done. But there's so much information here. I wanted to help people with how to deal with the weekly dividends across the board, how those weekly pays are operating. You have to do heavy research to invest in these because of the underlying assets. So hopefully I showed you a way of doing it. Let me know if you like it. Let me know if you agree or disagree with what we're going on. But best of all, if you're not a subscriber, hit that subscribe button, hit that bell notification, and most importantly, hit that like button that you like this channel. It really helps us out tremendously. Don't forget about the Seeking Alpha discount. Not pushing anything on that. It's just a nice, they did some nice things for us, and we're going to pay back them a little bit. Just advertising a little bit for them. I appreciate your time. We'll catch you next week.